Home Depot Inc. ticker symbol HD is currently trading at $283.02 a share. Over the last year, it is down almost 10%, but if we look at the last 5 years, this stock is up almost 62%. And if we compare that to the S&P 500, it is actually beating it 62 compared to 52%. Another reason this stock is well liked is because of its massive 2.95% dividend, which we'll be talking about later in the video. So what we're going to be doing today is looking at my automated stock valuation spreadsheet. Check out my Patreon if you're interested. But what this will do is it will bring in the latest financials of the company. Then we'll be looking at my models for valuation using discounted free cash flow, the Ben Graham formula, and the comparable companies model to see if Home Depot is a buy or a sell. So as I said, the stock is on a bit of a tear compared to the S&P 500 and has a very nice dividend that investors love. If we have a look, it was at all-time highs at around about $400 a share back in December and is down 30% since then. At the bottom of the pandemic, it was a $50 stock and has obviously gone up around about 86% since then. So can it get back to its all-time highs? Is the stock undervalued? Well, that is the question I'm going to be answering today. So firstly, let's put in the ticker, HD. You can see that everything loads up automatically. This is the financials of the company. Currently has a 287.3 billion market cap. P ratio, very, very low compared to the market average, 16.96. That is a good little thing we like to see. Earnings per share, $16.69. And a 0.93 beta, which should mean it's slightly less volatile than the S&P 500. Now, the dividend is something that people like, 2.95%. That means over the year, you will get $8.36 per share. The dividend they pay is 8.5 billion. So in terms of ratios, well, for net income, it is about 50%. And for free cash flow, it is about 75%. So this is a safe dividend. If you want your dividend, make sure to buy the shares before the 8th of June and you'll get paid that nice amount. So let's have a look at the revenue numbers right now. You can see the trailing 12 months are the same as the 2020, so we'll be ignoring them for now because their earnings hasn't come out yet. But we can see that revenue has grown quite a bit, 108 billion to 157 billion. Big growth, 1%, 20%, 14%, and now 5%. Next, you want to see if the net income is increasing, and yes, it is. 11.1 billion to 17.1. Very good growth and very in line with the revenue. That is excellent to see. And then finally, on the shares outstanding, are they buying back or issuing more shares? Well, you can see they have a pretty steady buyback program, around about 3% each year. So they're rewarding shareholders by buying back their shares and then therefore increasing your share of the company. Because if there's one, you own 5 shares and there's 10 shares, you own 50% in the company. If they then issued 10 more shares, your value or your percentage would decrease. So they're buying back the shares, which would reward shareholders. And then finally, is the free cash flow increasing? Well, you can see it's a bit all over the place. In 2018, it was 10.7 billion. It's now 11.5. They had highs back in 2020, but overall, it is steadily increasing. So if we look at the discounted free cash flow model, let's see what this value. So this calculates the future free cash flows of Home Depot, discounts them to today's value, and actually gives a share price of around about $297 a share, 298. Let's have a look at the numbers and see if we like them. So in terms of revenue growth, we had big revenue growth in 2020 and 2021. So this may be a little bit on the high side. We're going to bring this down to 4% to see what the numbers change. Net income margins, I'm pretty happy with this, 10%. I think this is a good value in terms of the averages here. And then finally, the net income to free cash flow. Well, we can see it's a bit all over the place. So we bring the average to 94%. I think that's fair. So that actually, with the decreasing revenue, gives us a 267. If we have a look at the more recent numbers, once again, if we give about 6.99%, then it is a 200. Oops, I've messed that up there. Let me undo that. 6.99. Then it's a $300 stock. If we look at the analysts and what they're expecting in terms of revenue, they have it at 156, 161, and on the high side 160, 168. So what do we have as similar numbers? Well, I think that's about the same number for the 2023. So we're in line. Discounted free cash flow does like the stock. Next, we'll have a look at the Ben Graham formula. This is created by the father in value investing, Ben Graham himself. What this does is it looks at the earnings per share, the growth rate or the P rate, P/E ratio of a non-growth company times by the corporate bond, 4.4, the average, and then the current. So the current bond yield is 4.56. And if we look at the expected growth rate of HD or Home Depot, what do analysts think it's growing at? Well, over the next 5 years, they're expecting about 2.22%. You can see the past 5 years was 16. So we're going to have a look at both numbers and see what the formula spits out. So 2.22. This would actually give a value of around about $150 per share, which is obviously considerably lower than what the share price is. But if it was able to grow at the same rate it grew over the last 5 years, then this is a, well, you can see here, $370 stock, and with the Ben Graham margin of safety, $280. So this would be a buy. So if they can grow at a similar rate for it to be fairly valued, you'd probably need them at about, well, you can see here, there, 11% over the next 5 years. That would give it a fair value what it's currently rated today. So somewhere between what they are estimated and what they've previously grown at. Then we look at the comparable companies model. This is a valuation method that compares against similar companies, whether in the same industry or size, looking at a series of metrics here, which is the EV to revenue, EV to EBITDA, and the PE ratios. What we want to see is lower on all of these. So let's have a look at some comparable companies. The main one we look at here is Lowe's, ticker symbol LOW. Target, I suppose, is something similar. Not TRG, Target, TRT. Oh, what is the ticker for Target? Actually, I did have this up. Target share price. TGT. Oh, what did I type in? I typed TRT. So let me undo that. TGT. And then finally, we'll look at Walmart. And we have some other companies we want to compare it to see. Because if we look at the EV to revenue, well, Home Depot has the highest here of 2.5 times. Lowe's is 1.7, Target is 0.8, and Walmart is 0.7. So in terms of EV to revenue, we want this to be lower. EV to EBITDA, you can see it is about the middle and pretty much on the average. The average here is 14.2, we're 14.3. And PE ratio, it has the lowest PE ratio of all of the companies, Lowe's, Target, and Walmart. So if we have a look at the valuations, well, in terms of EV to revenue, that's $180 stock, but EV to EBITDA, $330, and PE ratio almost $400. So if we take an average of all those three, that gives $303 a share. And as we've seen from looking at the stock, well, it previously breached numbers of 400, so it's a very realistic price. So if we look at all the models again, discounted free cash flow model says the stock is a buy. Ben Graham probably says it's not a buy, but depends on the growth rate. If they can match their previous growth, then it is a buy. And comparable companies model, comparing it to some of its competitors, it does look a buy as well. Right, guys, thanks for watching. Please give a like on the video if you enjoy it. Check out my Patreon if you're interested in this sheet. And subscribe if you're not already. And I'll catch you guys next time.